Welcome to our YouTube channel, Elimu Mtandao. Today, under subject accountants 1, we are going to see investment account. First of all, let us see what does it mean by investment. When you're talking about investment, we are referring to spending of money purposely to earn more money or income. And under investment, we have two kind of categories. We have trade investment and marketable security investment. When you're talking about this trade investment, we are treating them as a non-current asset. And when we are selling them, the profit obtained is transferred to the capital reserve. And we have this what we call marketable securities. And when we are selling them, the profit obtained is transferred to the profit or loss, or sometimes we call income statement. That will be added with the capital in the future. Then let us deal with this marketable security for the purpose of the topic of investment. When we are talking about these marketable securities, we are referring to different kind of security like government bond. We are talking about the shares. We are talking about the debentures, to mention a few of them. Now, under marketable security, we have two kind of treatment. We have those which treated with the fixed interest bearing investment, and those which have, we call them variable interest bearing security. So when you start with this fixed interest bearing, it means that for each kind of security, it will be having a certain fixed rate for the interest to be received or dividend to be received in future. So let's have an example. Let's say you have invested to the government bond, which having 6% and nominal value of, let's say it is 100,000 shillings. And the interest, let's say it is payable on 30th June, and the 6% government, let's say stock that having nominal value of 100,000. The interest received or payable on 30th and 31st December. In order to compute the interest per annum, it will be as follows. On 30th June, we are going to receive 6% of the nominal of this one, but remember this is per annum, so it means that we have to take 6 out of the total months per annum, which will give us the figure which is equivalent to 3,000. So this is 3,000 that will be received on 30th June, but 31st December also be receiving the same much, which is 6% of nominal value of 100 shilling times 6 out of 12, which also is 3,000. So for that particular year, if you are talking per annum, the total amount will be of that 30th June and December, which gives us of 6,000. So for each kind of the security which having fixed interest bearing, at the end of the day, this is how we are going to see. But again, under this one, we have quotations of the price. When you're talking about quotation, sometimes they can quote the price as 10, let's say 12. In order to know which one is for buying and which one is for selling, we are saying that the low price always it is selling price. That will be selling price, which is, for this case, it is 10, and the higher price, now this will be buying price, which is now, for this case, it is 12. So when you are given 10 to 12 as a price, you have to know that 10 it will be for selling price, and this is for buying price. So from this point of view, now we can have two kind of issues, that is what we call CAMDIV, and the other one which we call XDIV. Okay, for the issue of CAMDIV, the right goes to the buyer. It means the next installment to be received for the interest to be received by the buyer, but for this one to be received by the seller. So we need to do some adjustment if the purchase or sales was done in between the time of receiving the interest. So thank you for today.